For a while, everything looks perfect. Markets are calm. Growth is steady. Jobs are stable. No panic. No urgency. No reason to worry. And that's exactly when the system starts becoming dangerous. Not during chaos. Not during crashes. But during the quiet moments, when nothing seems wrong. Think about the months before a storm. The air feels still. The sky looks clear. There's no obvious sign of what's coming. But pressure is building. That's how modern economies work. The biggest risks don't appear when people are afraid. They appear when people stop being afraid. This matters more than it seems. Because most people are trained to look for danger in the wrong places. They watch headlines during crises. They panic when markets fall. But by the time fear shows up, the real damage has already been done. The risk was building long before anyone noticed. To understand why the economy becomes riskier when everything is going right, you have to stop thinking about risk as something visible. And start thinking about it as something that accumulates quietly. Let's start with a simple idea. Every financial system runs on expectations. Businesses invest because they expect demand. Banks lend because they expect repayment. Investors buy assets because they expect future returns. Expectation is the fuel. And stability strengthens those expectations. When the economy is unpredictable, people hesitate. They borrow less. They invest carefully. They question assumptions. Uncertainty forces discipline. But when everything feels stable, that discipline begins to fade. Slowly, subtly, almost invisibly. At first, nothing seems wrong. A bank approves a slightly larger loan. An investor takes on a bit more risk. A company expands a little faster than before. Each decision makes sense on its own. Each step feels rational. But collectively, they begin to reshape the system. This is the part most people miss. Risk doesn't usually explode out of nowhere. It builds. Layer by layer. Decision by decision. And stability accelerates that process. Because stability changes how we measure danger. When markets are volatile, risk feels obvious. Prices swing. Losses appear. Warnings are everywhere. But when markets are calm, risk doesn't disappear. It just becomes harder to see. Financial models start relying on recent data. And recent data looks safe. Volatility is low. Defaults are rare. Prices move smoothly. So the system concludes. This is normal. But it's not normal. It's temporary. And here's the problem. When you measure risk using calm periods, you systematically underestimate how dangerous things really are. This is how stability distorts perception. It doesn't remove risk. It hides it. Now layer in incentives. Because incentives quietly push this process forward. Banks make money by lending. Investors make money by taking risk. Governments benefit from growth. No one is rewarded for being cautious during good times. In fact, caution can look like a mistake. If you don't take risk when everyone else is, you fall behind. So the system nudges everyone in the same direction. More borrowing. More investing. More exposure. And because things keep working, those decisions feel justified. This is where the shift becomes dangerous. Not when risk appears, but when risk starts to feel normal. Let's make it concrete. Imagine a housing market during a stable period. Interest rates are low. Jobs are secure. Prices are rising steadily. At first, people buy homes they can comfortably afford. Safe decisions. Manageable debt. Then prices keep rising. And something changes. Buyers start stretching their budgets. Banks become more flexible. Lending standards loosen. Not dramatically. Just slightly. Because nothing bad has happened. So the system assumes nothing bad will happen. Then it goes further. People start buying second properties. Investors enter the market. Speculation increases. Prices rise faster. Confidence grows stronger. And now the logic shifts. People aren't just buying homes to live in. They're buying because they expect prices to keep rising. This is where risk transforms. It's no longer based on income. It's based on expectations. As long as prices rise, everything works. But if prices stop, everything changes. And that's the fragility. Not visible on the surface, but embedded in the structure. This pattern doesn't just apply to housing. It applies to the entire financial system. Stocks, corporate debt, government borrowing. Stability encourages expansion everywhere. Companies take on more debt because borrowing is cheap. Investors push into riskier assets searching for returns. Governments run larger deficits because financing is easy. Each decision is logical in isolation, but together, they create a system that depends on things continuing exactly as they are. And that's the hidden risk. The system becomes dependent on stability itself. Now here's where it gets uncomfortable. the longer stability lasts, the more fragile the system becomes. Because stability isn't just a condition. It's a feedback loop. Calm leads to confidence. Confidence leads to risk-taking. Risk-taking builds hidden fragility. And that fragility makes the system vulnerable to disruption. But the disruption doesn't need to be dramatic. It can be small. A slight increase in interest rates. A slowdown in growth. A minor drop in asset prices. On their own, these things are manageable. But in a system built on leverage and expectations, they don't stay small. They spread. Because everything is connected. If asset prices stop rising, investors can't rely on gains. If investors pull back, prices fall. If prices fall, borrowers struggle. And when borrowers struggle, the entire system begins to unwind. What once looked stable suddenly looks fragile. This is the moment people recognize as a crisis. But it's not the beginning. It's the reveal. The real story happened during the years of calm. During the period when nothing seemed wrong. This is why crises often feel surprising. Not because they're unpredictable, but because the risk was hidden. Now zoom out. Because this isn't a one-time pattern. It's a cycle. After a crisis, everything resets. People become cautious again. Debt is reduced. Risk-taking slows. The system becomes safer. For a while. Then stability returns. Confidence rebuilds. And the process starts again. It's almost mechanical. Stability leads to risk. Risk leads to fragility. Fragility leads to crisis. And crisis resets the system. Over and over. Now add one more layer. Human behavior. Because this cycle isn't just financial. It's psychological. After a crisis, people remember the pain. They become careful. Skeptical. Risk-averse. But memory fades. Over time, new participants enter the system. People who didn't experience the last collapse. To them, rising markets feel normal. Stability feels permanent. And so they behave accordingly. They take more risk. Trust more easily. Assume the system is safer than it is. Not because they're reckless. But because they're adapting to what they see. This is what makes the cycle so persistent. It doesn't rely on mistakes. It relies on normal behavior. And normal behavior becomes dangerous? In a stable environment. There's an irony here. The better things look on the surface. The worse they can be underneath. Because visible stability often hides invisible instability. Now consider where we are today. In many parts of the world, we've seen long periods of relative calm. Low interest rates. Strong asset markets. Consistent policy support. Volatility has often been subdued. Crises, when they appear, are quickly contained. On the surface, it feels like progress. But beneath that surface? The same dynamics are at work. Debt levels have risen. Asset valuations have expanded. Markets have become more interconnected. None of this guarantees a crisis. But it changes the system. It increases sensitivity. It reduces margin for error. And it makes small disruptions more impactful. This is the uncomfortable truth. Risk doesn't build when things are falling apart. It builds when things are working. Because that's when people stop questioning the system. That's when assumptions go unchallenged. That's when leverage quietly accumulates. And that's when the system becomes most exposed. Now here's the question that matters. If risk builds during stability, how do you respond to that? Because reacting too early has costs. Tightening conditions during good times can slow growth. It can feel unnecessary, even harmful. But reacting too late allows vulnerabilities to grow. This is the dilemma policymakers face. And there's no perfect answer. Because the transition from safe to risky isn't obvious in real time. Each step looks reasonable. Each decision feels justified. Until suddenly, they don't. And by then, the system has already changed. This is why the idea is so unsettling. It challenges a basic assumption. That stability means safety. Because in reality, stability can be the very thing that makes the system dangerous. Not immediately. Not obviously. But gradually. Quietly. Inevitably. So the next time everything feels calm? When markets are steady? When growth looks reliable? When risk seems under control? It might be worth asking a different question. Not whether things are stable, but what that stability is allowing to build beneath the surface. Because the most dangerous phase of any system isn't when it's under stress. It's when it looks like it doesn't need to worry at all. And that leaves one uncomfortable thought. If the economy becomes riskier precisely when nothing is going wrong, then how do you ever know the difference between true stability and the kind that quietly sets the stage for the next crisis?